welcome back to the show. Now, the 4% growth that we saw in the second quarter could be a sign that the U.S. economy is finally turning a corner. Yet, hold the door. At the same time, we're still clawing back from our contraction in the first quarter, so I guess it equals out. So how healthy is the recovery? That's the real question. And earlier I sat down with Peter Schiff, CEO of Euro-Pacific Capital. Peter is bearish on the U.S. economy and the effects of Fed policy, and I first asked him if he could give me his take on the recent GDP numbers. Here's what he had to say.
Well, first of all, the plus 4% that was just released today is a preliminary number and is very likely to be revised downward, maybe even significantly so in the months ahead. So I wouldn't jump to any conclusions based on the first look, because historically, or at least the past several years, these numbers are almost always revised downward. But even if you accept the 4% number for now, it still shows that the U.S. economy barely grew in the first half of 2014. Total growth is just shy of 1% annualized, which is much less than the 3% or so that people were looking for at the end of 2013, the very beginning of 2014. And I think those people who are drawing a false sense of comfort, right, from this 4% number, they think, well, this shows that the first quarter was just a weather-related anomaly. No, it doesn't. Because even if the first quarter was depressed because of weather, the second quarter got an artificial boost because activity that should have taken place in Q1 but didn't because of the weather took place in the second quarter. So if you assume that maybe weather took 2 points away from the first quarter GDP and added 2 points to the second quarter GDP, which historically is what happens over the last 50 or 60 years when you get a very bad winter. If you strip that out, we really got minus 0.1 in Q1 and plus 2 in Q2. And a plus 2 number is nothing to get excited about. So I think the markets are overreacting to economic growth that really is not there. And in fact, I think that this Q2 number is going to be the high for the year, and it's all downhill from here.
Peter, a lot of people look at FedEx, UPS, and Walmart as almost proxies for economic activity in the U.S. So which companies in the U.S. stock market do you look at as proxies for overall economic activity, especially in terms of forward guidance?
Well, I don't look at any one company, but the ones that you mentioned in particular had disappointing earnings, and a number of other companies that have reported in the last couple of weeks that cater to the middle class, consumers. They're reporting weaker than expected numbers. We also have had weaker numbers in the home builders. And in fact, if you look at a lot of the housing data that's been coming out over the past several weeks and several months, it has generally been disappointing numbers. And so I think the housing recovery is already over and the market is already reversing. And remember, the Fed is basing its optimistic forecast on the housing market continuing to grow, because the phony recovery is built on a foundation of asset bubbles in stocks and real estate and the resulting wealth effect from those bubbles. But if they're already deflating, then the Fed's whole thesis unravels.
Now, some people think that the U.S. economy's recovery has very much been an asset-based one. So I want to talk to you about asset markets this time. And first, let me ask you about, the debt underlying those assets. Now, listen to this. According to an Urban Institute study, an estimated 1 in 3 adults with a credit history, now that's 77 million people in the U.S., are in collections. And that's a just shocking number to me. So does that surprise you? And what do you make of this statistic?
Well, not at all, because I think most Americans that are having trouble paying their bills are not benefiting from the rise in the stock market because they don't own any stocks, or they're not benefiting from the increase in real estate prices because they're renting now, or even if they own real estate, they're still underwater. Maybe they're under less water than they used to be, but it's still a negative number, so it doesn't help you pay the bills. In fact, if you look at the interest rates on credit card debt, it's been rising. In fact, the spread between credit card rates and treasuries is the highest it's ever been. And, you look at other segments of the economy, even junk bonds, interest rates are at historic lows, yet consumers are paying higher interest rates on their credit cards now than they did in the year 2000, when interest rates were higher in general than they are now, yet they're paying higher rates, even with the Fed funds at zero. And the reason for that is because of delinquencies, because so many people can't pay their bills. The credit card companies have to charge those people who are paying their bills an even higher rate of interest in order to make up for the losses on the people who aren't paying. And this is indicative of a economy in distress, of a consumer in distress. And this wouldn't be the case if we had a legitimate economic recovery. But the fact is we don't. We have a real recession that underlie these phony numbers. The labor force is collapsing. People are losing their full-time jobs. They're replacing them with part-time jobs. They're drowning under a pile of debt, money that they borrowed in the past to pay for past consumption, or whether it's a mortgage or a credit card debt or a student loan or an auto loan. Meanwhile, the cost of food is going up. The cost of health care is going up. Their electric bills are going up, and they don't have the income to service it. They're relying more and more on credit cards to bridge the gap, and now they can't pay their credit card bills.
You know, Peter, I want to ask, though, prior to the recession, people were using, credit cards with lower interest rates to pay off other credit cards. Maybe the higher interest rate, perhaps, I'm just throwing this out there, maybe the higher interest rate is a good thing in a correction, no?
Well, it's not a good thing if you have credit card debt and you're being charged a rate of interest. But what it shows, though, is that there are these losses in the credit card industry because interest rates are going down for everybody except consumers who want to use credit cards. They're going up. And, I'm not a fan of consumer credit. I don't think consumers should be using credit cards at all to buy things. I think they should only buy things if they have the cash. The problem is today Americans don't have the cash. And, they're not using their credit cards for luxuries. They're using them for necessities. People are using their credit cards to buy their groceries because they can't afford to pay for it.
That was Peter Schiff, CEO of Euro Pacific Capital. Time now for today's Big Deal.